We know the monetary measurement of silver says it could seemingly go to $500. Our assumption is that it will occur very quickly, meaning within a couple quarters probably. Well, our clock began when? After the close of November. That's when the spread broke out.
Michael Oliver has issued what may well be his boldest forecast to date, a price between $300 and $500 per ounce of silver, and what's more, within the current calendar year. While everyone else saw nothing but chaos in silver's price chart, Oliver discerned the first signs of one of the greatest bull markets in history. The metal had skyrocketed to an all-time high of $121.79 in January, plummeted to $61.20 in March, and then experienced a sharp reversal in the span of just a few hours. In 2015, the Wall Street Journal described Oliver's approach as a price momentum tracking method designed to reveal trends that have been brewing for a long time. When silver was trading at $40, Oliver's models pointed to a target of $100. He was right. His methodology successfully identified Cooper's structural breakout in 2003. Subsequently, the metal skyrocketed from under $1 to over $4 by 2011. Lead confirmed that structural pattern in 2007, seeing its price nearly triple in less than 18 months. According to Michael Oliver, silver can surge to at least $500 in the coming months. Before we move forward, if you want to stay up to date on the latest gold and silver news, you can subscribe to our channel and like this video. Now let's get back to Michael Oliver's view on gold, silver, and the overall global economy.
We got bullish on oil. We've been monitoring oil as a likely upturn market for over a year now. And if you look what happened after the 2022 high, oil peaked at like 130.
Oops. Oh, I'm on log here. There we go.
Yeah, there you go, back in 2022. And you went down and you lived mostly above 60. But then late in that process in 2025, you got down in the mid 50s.
Yeah.
Well, that's less than half the price of the peak that had occurred then, and a very low price for oil going back decades even. So it was very cheap. And you can see that the downside pressure just dissipated.
Yeah.
In 2020. You see a lot of little bars there that are just doing nothing. Okay.
Yeah.
Well, when you came up out of that hole in the January close, we got above 63. That was our buy signal, getting above 63 in January. And we closed above that month above it. At that point, we put out a major long-term buy signal on oil saying, okay, bull trend is commenced.
Yeah.
Well, the war started a couple of months later. But I mean, oil was already turning up in January. And February was higher. And then, of course, the news hit. Yes, oil we think is going up. The whole commodity complex is. Our buy signal for Bloomberg Commodity Index was back in October. Oil was a laggard this time. And I think the entire commodity complex, including oil, are headed much higher over the next couple of years. There are bigger fundamentals at play and there are bigger technicals at play. So we view this recent break in the S&P. In fact, going back to November, we were saying, hey, not November, back up. Prior to the March sell-off anyway, in early 2026, we were saying, hey, you needed to have a rally. You need to get back up near the highs. And sure enough, we've had that rally now. And also maybe it'll hold up here for a while and put everybody to sleep. And suddenly you're left with the underlying longer-term reality of the fundamentals and of the long-term technicals that we watch. And they argue to us, especially the technicals, that we are in a topping process, have been since early last year when we got up above 6,000, and even the extension up here to 7,000 we got to this year. Year-long topping process. And that's what we've been seeing. Similar behavior occurred back in 2000 dot-com top.
For nearly 5 decades, in 1980 and subsequently in 2011, silver approached the $50 mark, only to be rejected in each attempt. This threshold eventually acquired an almost mythical quality. Now the market has left it behind. When silver breached the $100 barrier in January 2026, what appeared to be a simple advance turned out to be precisely that, a decisive breakout. Oliver terms the phrase immediately following the breach of multi-decade resistance, A lightning reevaluation, a violent, rapid movement that corrects the price level at which the metal should have been trading all along, once structural price suppression is lifted. The sequence of events in the first quarter of 2026 served to confirm this pattern. Silver reached a high of $121.79 before plummeting nearly 50% to retreat to $61.20, a violent pullback concentrated within a single quarter, only to execute an aggressive reversal just hours after hitting that bottom. This behavior, absorbing extreme selling pressure at a key technical level and then immediately rebounding with great speed, is what Oliver described as the hallmark of a true structural bull market capable of absorbing weak hands rather than of a mere failed rally. A mining company producing at a cost of $20 per ounce generates a margin of approximately $60 at current prices. If the price of silver were to reach $300, that same producer could capture nearly $280 per ounce. Profit does not increase linearly with price, but rather multiplies. Oliver has publicly stated that this specific segment is precisely where he is personally concentrating his capital. However, he issues a clear warning: the volatility will be grueling. Silver has already fluctuated by nearly 50% in a single quarter during the first quarter of the year. Nevertheless, the monetary backdrop, the structural deficit, the breakout above resistance, and market momentum indicators, they remain unchanged. According to Oliver's analysis, his forecast of a price ranging between $300 and $500 by 2026 does not mark the end of the story. Rather, it serves as a starting point for a new phase of price appreciation. During the first 4 months of 2026, U.S. military actions abroad reshaped global oil flows in a way that markets are still struggling to price in. On January 3rd, U.S. Special Forces captured Venezuelan President Nicolas Maduro inside a presidential compound in Venezuela, leaving the country's leadership in the hands of his second-in-command, Delcy Rodriguez. Subsequently, on February 28th, the United States and Israel launched a multi-front offensive attack against Iran. One company stands out in both threateners of operations, Chevron. In both Venezuela and the Middle East, Chevron holds business interests valued at billions of dollars. While Venezuelan oil exports have increased since January, the war in Iran presents a very different picture. Chevron's share price has declined in recent weeks, suggesting that some of these dynamics may already be priced in, or that they may be offset by broader market concerns. Chevron's share price has risen 35% since the beginning of the year. However, it has also been reported that Chevron lost approximately 6% of its global production during the first quarter. Furthermore, financial hedging operations are expected to moderate the increase in earnings generated by the upstream segment. Mike Wirth, Chevron CEO, believes that the market has not yet fully priced in the impact of the conflict in Iran. That's all for today. Let us know your views in the comment section below, and don't forget to like this video before leaving. Thanks for watching.